The purpose of this video is to show and explain the differences in disclosure between an asset that falls within the scope of IAS 16, property, plant and equipment, and assets that fall within the scope of IAS 40, investment property. As you will see on the current slide, both property, plant and equipment and investment property are disclosed as non-current assets in the statement of financial position. What you need to take note of especially is that property, plant and equipment and investment property are disclosed separately under non-current assets. The reason for this is that the definition of property, plant and equipment and the definition of investment property is completely different, and therefore we are looking at two completely different types of assets, which therefore need to be disclosed separately. Property, plant and equipment typically consists of items that will be used in the long term in order to generate an income for the business. If you think of a factory building, you need your factory building in order to manufacture a product. If you do not have a place to perform the manufacturing process, you will not have a product that you can sell and therefore you will not derive an income. Think of equipment. You need equipment in order to manufacture your product. Without the equipment, you cannot do anything, and therefore you need the equipment in order to generate an income. Think of your delivery vehicles. It may be part of your business model to deliver whatever it is that you sell. You need the delivery vehicles in order to perform the service and therefore to generate an income in the form of sales. So all of these items are items that will be used in the long term in order to generate an income. When we have an item or an asset that falls within the scope of IAS 16, property, plant and equipment, we know that the entity has an accounting policy choice. They can choose to either measure the assets using the cost model or using the revaluation model. With the cost model, the asset stays at cost in the financial statements, less any depreciation and impairments in order to get the carrying value at the end of the year. With the revaluation model, the asset will be revalued to a new carrying amount every year or every 2 years, whatever the policy of the business may be. What's important to note is that on both the cost model and the revaluation model, these assets will be written down in the form of depreciation. If you have an asset on the cost model or an asset on the revaluation model, there could be an impairment. And under both models, you could have disposals and additions. What's important is that as soon as you are dealing with an asset on the revaluation model, when you have your property, plant and equipment note, and you are showing how you get to your opening balance, you will need to show cost or revalued amount. Because if you are dealing with a revalued asset, you are no longer dealing with a cost, you are dealing with a revalued amount. If you have an asset that is held on the revaluation model, it is important that in your disclosure at the bottom of your PPE note generally, you provide information about what the carrying amount of the asset would be if the asset had been held on the cost model. So if you are required to provide narrative information in a test or in a question that you practice, the narrative information typically refers to when an asset is held on the revaluation model, the carrying amount had it been held on the cost model. It's also important to note that when you have an asset that is held on the revaluation model, you need to state that the revalued amount or the fair value or whatever it may be has been determined by an independent sworn appraiser, and you need to give the date of the revaluation. When we talk about revaluations, we know that revaluations typically go through OCI unless you had a previous revaluation deficit which was recognized in profit or loss. Then the revaluation would go through profit or loss as well. So when we talk about revaluations, we're typically talking about revaluations through OCI and the revaluation surplus, which is a column in the statement of changes in equity. This is completely different from a fair value adjustment that is recognized under IAS 40 investment property. When we refer to investment property, we typically refer to items that have been held for capital appreciation purposes or items that have been held solely for the purpose of being rented to third parties. We know that under IAS 40 investment property, the entity once again has an accounting policy choice, and they can choose whether they are going to recognize the investment property according to the cost model or the fair value model. So under investment property, we talk about a fair value model and not a revaluation model. On the current slide, I'm showing you what an investment property note would look like under the cost model. So once again, you would separate your different types of investment property. So you would separate your land and your building. You would start off with your opening balance, which is made up of your cost less your depreciation, and that then gives you the carrying amount at the beginning of the year. Investment property can be impaired. If investment property is impaired, you will deal with it as it should be dealt with in terms of IAS 36, impairment of assets. Investment property can be disposed of, and investment property can also be added to. And when we speak about additions, it can either be replacements or just subsequent additions made to property. Once again, if investment property is held on the cost model, this investment property will also be depreciated, and the investment property will be depreciated according to the depreciation methods outlined in IAS 16. That then gives us the closing balance, which is made up of cost less accumulated depreciation and impairment. If the investment property is to be accounted for according to the fair value model, the investment property note will look a little different. So with the investment property note, if you are dealing with land and buildings, we generally lump the land and buildings together because the fair value will usually be determined for the unit as a whole, and the unit being the land and the building. They're not going to separately value the land and separately value the building in most cases. So once again, you will start off with the opening balance. You can then have an addition. Okay, if you have an addition to your investment property held under the fair value model, you will first account for it at cost. If you have a disposal, you will account for the disposal at its carrying value at date of disposal, and you could have an addition once again, and this addition could be because of a subsequent purchase or something that's been capitalized to the property, or it could be the replacement of a property. If it's replacement, you will generally have a disposal and an addition in the same financial year. We then have a fair value adjustment. Now what's important is that a fair value adjustment is not the same as a revaluation. Okay, a fair value adjustment takes the carrying value of investment property to its fair value in the market. Now this fair value adjustment does not go through OCI. This fair value adjustment will either be recognized as an income or an expense in the statement of profit or loss and other comprehensive income. When will the fair value adjustment be an income? It will be an income when the fair value of the property exceeds its carrying value. When will the fair value adjustment be accounted for as an expense? When the fair value does not exceed the carrying value, and therefore the carrying value exceeds the fair value. What's important is that under the fair value model, there will not be any depreciation written off. So under the fair value model, you will just have a fair value adjustment each year, no depreciation. And at the end of the day, you should have a closing balance which has the investment property sitting at its fair value at the end of the year. That brings us to the end of this presentation. I hope the difference between IAS 16 disclosure and IAS 40 disclosure is a little more clear.